Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Jake Robbins, manager of the Premier Global Alpha Growth Fund. Hi Jake.
Hello.
So with the caveat of the fact that you are a stock picker and you do invest in companies based on their fundamentals, of course with any type of investing you need to bear the macro in mind. I thought today we could talk about regional weightings and where you're seeing the best opportunities in the world. If we sort of backtrack to last year, you were overweight US, but you've come out of the US a bit. Where has that cash gone?
Yeah, indeed. So last year we were very overweight the US. We thought the economy was recovering very strongly. We thought valuations didn't fully reflect the earnings potential of US companies. And at the same time, Europe was clearly continuing to struggle, and valuations, because the market had done so well, were very high and in our view, very unattractive. As we got towards the end of the year, the US had outperformed quite strongly, so therefore the relative valuation case didn't really add up anymore. And secondly, it became very obvious that the Fed, as next move, was to raise interest rates. So quantitative easing had ended, and we were nearing the first interest rate hike for 5 or 6 years. Conversely, in Europe, after significant underperformance, it became very obvious that the ECB would be forced to undergo its own quantitative easing programme, and with valuations looking a lot more attractive, coupled with a very weak euro, the fall in the oil price is very stimulative for the European economy. We shifted the overweight from the US into Europe.
And are you pleased with that decision? Because it's not exactly been a smooth ride so far this year. Little old Greece has helped to create some volatility.
Indeed. No, I mean, even after the volatility that we've seen recently with Greece, Europe has still outperformed the US. So we feel justified with that decision. After the recent sell-off because of Greece, we do think valuations are again very attractive. And the one thing we also know is that the ECB will do everything to keep stability in both the bond market, and that tends to feed into the equity market. So very confident that over the medium term, Europe is still the place to be. Clearly in the short term, with the headline risk from Greece, there will be some volatility.
So that's developed markets done. What about emerging markets? Because of course you are a global fund, so your remit is unconstrained in terms of region. Where are you seeing the opportunities, if at all, or is it just, you know, keep away from those risks at the moment?
So we've historically been quite overweight the emerging markets. The main reason being is they have many fundamental growth drivers that developed markets just don't. So they have very young populations. They have populations who are just reaching middle class and reaching the level where they actually have cash to spend. So there's a lot of growth in the consumer area. However, having said that, emerging markets did very, very well. Valuations again became less attractive. And historically, when the Fed raises US interest rates, emerging markets tend to be very sensitive to that. A lot of companies and indeed governments still have US dollar denominated debt. So the US, when it tightens its monetary policy, it's actually magnified in the emerging markets. So really acts as a brake on their economies.
So just finish there as we dot around the globe on Japan, because I know that's another region that you're actually very positive on, developed market, for a similar reason perhaps that you're positive on Europe, because of this huge swathe of quantitative easing, or I think the Japanese are calling it QQE, qualitative quantitative easing.
Yeah, so obviously all the benefits from QE, but the other angle that Japan has is there is genuinely a corporate governance shift in attitude. So previously, Japanese management have really run the business for their own good and the employees, and largely ignored shareholders. Recently, through government regulation, they've been encouraged to focus on things like margins, return on equity. They've been encouraged to pay much higher dividends. They tend to sit on a lot of cash on the balance sheet. So getting that off the balance sheet and returning it to shareholders is just another reason to own Japan.
Jake, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.